Break down these numbers for us, this hot print.
Yeah, it's a major surprise. So it shows the labour market still hot and cooling more slowly than expected. It shows that the economy is more resilient than we thought. And that's a double-edged sword, of course, because it's going to spur inflation. Unemployment fell unexpectedly. Earnings shot up, beating expectations. So economists already thought that there was going to be another hike in June. Now it's looking pretty nailed on. The question is, will it be the last one, or will there be another one in August? Markets were already pricing a peak rate of 5.6%. That's the highest level they'd seen since May. And in response to this, as you say, the pound has risen. It's seen it as a hawkish reading the markets. It's up against the dollar as much as 0.5%, $1.25. Also of note for the Chancellor, 257,000 days were lost to strike action. This is the month April when junior doctors and passport workers were striking. It's cumulatively now some of the highest numbers since the 1980s, so it adds to pressure on the government to settle that industrial action.
Lizzy, we're almost certainly going to see yields at the highest level since 2008, above that kind of mini budget tantrum levels from last year. How far will they go, and is this just purely about inflation?
Well, it's partly in response to comments from Catherine Mann, who, of course, is one of the most hawkish members of the Monetary Policy Committee. Even before this jobs data, she was warning about the tight labour market and sticky inflation, particularly that core inflation reading that we saw in the latest data. You also heard from Jonathan Haskell, another Monetary Policy Committee member, warning that the bank needs to keep leaning against this inflation to keep a lid on it. So this is what the markets are responding to. As you say, you saw yields rising to levels that were flirting with those seen in the truss era, if we can call it that.